We all make mistakes in life. And when it comes to mistakes in your investment portfolio, outcomes can include low returns and missed opportunities. Thankfully, we can look back to some of history's greatest investors and learn from their experience. Today, we'll look at Warren Buffett and 3 investment mistakes that he cautions against. And while Warren Buffett is a stock picker, his investment wisdom can still be applicable to our portfolios as well. Let's get into it. Mistake number 1, investing in things you don't understand. Warren Buffett once told Forbes magazine that investment must be rational. If you can't understand it, don't do it. Have you ever been tempted to jump on the latest investment trend that promises get-rich-quick results? If not, you probably know someone who has. The problem with investing in this way is that you don't know what's in your portfolio. It's like trying to fly a plane without understanding the controls. Not understanding what's in your portfolio means you won't understand the impact that these investments can have. For example, if an investment starts to outperform the rest of your portfolio, you could be tempted to go all in and increase your allocation to that investment when it's at its peak. Better understanding as to why this outperformance has occurred means that you can make better decisions about portfolio allocation. And this goes for ETFs and managed funds too. Think about an ETF advertised as defensive and low risk, but actually holds some volatile assets within it. Your carefully constructed portfolio isn't going to react in the way you expect to certain events or market conditions because you don't understand what's in the ETF. If you don't understand the holdings or the fee structure, then you're going to be surprised by their performance. Thankfully, ETFs are transparent, which means that all of the holdings and fee information can be found on the fund issuer's webpage. Understanding your investments before you invest isn't going to allow you to predict your performance, but it does allow you to control the controllables, maintaining an appropriate level of risk, ensuring that your portfolio is diversified, and also having a clear understanding of the costs involved. Mistake number 2, letting your emotions drive your investments. In his 1986 letter to shareholders, Buffett wrote, "Be fearful when others are greedy, and be greedy when others are fearful." The quote is referring to the cyclicality of investment markets and also the danger of letting emotion influence your investment decisions. This is one that I'm personally guilty of. Sometimes our emotions can influence our investment decisions for the worse if we let them. As we enter periods of market upturns, excitement and euphoria grip us. This is the greed that Buffett is talking about. It leads to confidence in the market or our investment ability, which can cause us to increase our level of risk when we should actually be more cautious. On the other hand, when markets are in a downturn, panic and fear may grip us and prevent us from investing, causing us to reduce our level of risk or sell our holdings altogether at precisely the wrong time. Buffett points out that this might be the best time to be greedy by making investments when prices are lower. Letting the herd mentality of the market dictate your investment decisions is a really great way to achieve lower returns. Ask yourself the question, are my investment decisions rational, or are they being driven by my emotions? The final mistake that Buffett warns about is investing for the short term. He is a fanatical supporter of long-term investing. He said, "Someone is sitting in the shade today because someone planted a tree a long time ago." He also said in a chairman's letter to his investment firm, Berkshire Hathaway, that our favorite holding period is forever. Holding a long-term investing mindset helps to reduce the risk of emotional investing amidst the day-to-day market movements, but it also allows investors to capitalize on compound returns. Compounding refers to earning returns on your returns. Buffett attributes a large portion of his success to the power of compounding. Consider this chart, which maps Buffett's wealth as he grew older. It's only in the last 25 years or so that his wealth has reached multi-billion-dollar figures. The exponential shape of this curve is due to compound returns. Simply put, the sooner you start putting your money to work, the more you're going to benefit from the compounding effect, and the less you'll have to save to reach your financial goals. And holding over the long term and reinvesting your income is a tried and tested method to build wealth. So those are 3 mistakes that Warren Buffett cautions against. Now, even the most seasoned investors still make mistakes, but hopefully knowing and understanding more about these mistakes, we can better stay on track to building long-term wealth in our portfolios. And remember, as Buffett once said in an interview,
by far the best investment you can make is in yourself.
So if you want to invest in your financial education, check out some of our other content to help set you up on a lifelong financial journey. Bye for now.